G'day, Scuddy here. Another hot US inflation report overnight is warning that the pipeline of price pressures flowing through the US economy is broadening again. And importantly, it's no longer just a pure energy story. Historically, that's often an uncomfortable combination for the Fed because upstream price pressures have a habit of eventually finding their way through to the consumer level. Producer prices, shown on the right, surged 1.4% in April, the largest monthly increase since March 2022, which pushed the annual rate up to 6%, which was the highest since late 2022. But the detail is what matters. Services prices jumped 1.2% over the month, the biggest increase in 4 years, while core goods prices, excluding food and energy items, rose 0.7%. In other words, businesses are increasingly passing on high input costs, and with the US consumer continuing to spend aggressively, there's growing risk that upstream price pressures flow through to consumers, which is already lifting as seen in the left of the chart in the months ahead. We'll get April retail sales data out later today, which will be crucial in assessing whether the US consumer is still spending with the same level of strength, because for now, demand still looks resilient enough to absorb those higher prices. Markets have responded by abandoning Fed cut expectations altogether, with futures now pricing a small amount of tightening by the end of this year. Even more remarkably, implied Fed funds pricing by the end of next year now sits above the current effective Fed funds rate. Of course, trading volumes that far out the curve are very thin, so you don't want to overstate the signal it's providing. But it suggests that incoming Fed Chair Kevin Walsh may have his work cut out convincing fellow FOMC members that easier policy is warranted anytime soon. With front-end US rates pointing to the risk of tighter policy moving forward, one chart worth watching is US 10-year Treasury note futures shown on your screen. While the price has been battered in recent months, the bearish retracement following the wedge break in April is now complete, with Wednesday's doji forming what is 2/3 of a potential Morningstar bullish reversal pattern. To be clear, it's still a sell on rallies environment, with the price remaining beneath the key moving averages and with momentum indicators continuing to favour downside. But if we see today's candle push meaningfully higher, it suggests we may have seen a near-term top in benchmark 10-year yields. If correct, it could help relieve pressure on economically sensitive parts of the US equity market, while also reducing some of the upward pressure that widening rate differentials have been placing on currencies like the Japanese yen. Best of luck with your trading. I'll catch you next time.